Hey Karen, how are you doing? I hope this video finds you well. I thought I'd put this together just to explain the wacky market we've been in. And let me just go out a quarter view on this window here. What you're looking at in front of you is the Fannie Mae mortgage bond that trades every day in the open market. The chart in front of you shows the intraday high and lows, open and close, and it's very confusing. It's taken me years to master the technical aspects of tracking these mortgage bonds and seeing where the trends are going. But if you can see right here, as of the end of May, up until earlier this week, we lost over 800 basis points in bonds, causing the biggest pretty much a 1 month increase in rates in the last 40 years or so. So we're just in very volatile times, but here's a savings grace here. This is called a hammer pattern, which took place 3 trading days ago. This is a very strong reversal pattern that indicates the recent pattern is reversed. So we've been in a downwards pattern, which has been causing rates to increase. This came through, and since this pattern emerged, we have gained about 200 basis points in rates. Now, after having such a large move to the downside, normally mortgage-backed securities appreciate in price, causing rates to decrease. It's really understanding the technicals to know at what point they may stall and not further appreciate, and when to lock a loan. Now you have some time ahead of you before you have to lock your loan. Look at the technicals. I would say right here, which is a 25-day moving average, and this little block would be probably where rates stop coming down and mortgage-backed securities stop increasing. Just because whoever held on to bonds at this point and then felt this huge drop, they may not be willing to hang around for too long, and they may just want to get their money back and sell their positions. Also, technically speaking, the 25-day moving average does act as a lid in cap pricing. So what I would suggest is to kind of float the rate until we hit this point right here. This will decrease your rate by about another 1/8 to 1/4 percentage point, and at this point, we'll see if we can continue floating or if we should lock. If pricing hits these levels and continues to rise, obviously we want to continue floating until we reach the 50-day moving average, which is right here. This will create almost a 3/8 percentage point drop in rates. So that's my suggestion to you. Not many people in my field understand how to do this. I have a background in finance, which really helps me give proper counsel to my clients, and all I ask of you is the commitment to work with me and Colleen and get you to the closing table, because we're really in very volatile times, and without having a major background on how these things work, it's just really hard to navigate these markets. And I know you want to get the lowest rate possible, and you're doing your shopping and due diligence, which is what any educated consumer should do, but just being in the mortgage business for as long as I've been in the mortgage business, and attending national events and participating on panels and national events, I do understand that there's very few loan officers out there that understand how to do this. And I would challenge you to ask any other loan officer how does technical trading work, and how does it correlate to rates going up or down, and or just ask them simply what next piece of economic data that is pending will impact trading. And if they can't tell you that, then they shouldn't be giving you advice on when to lock your rate. So I hope you enjoyed this video I put together for you. If you have any questions, give me a call. And oh yeah, one last thing. I know you're interested in waiving the escrows and paying the taxes and insurance separately. We could definitely do that for you. Just so you know, it's a kind of a trade secret. What occurs when you do that is it's just priced into the loan. So either you're sacrificing a slightly higher rate, or sacrificing a higher credit back at closing for closing costs and prepaids by working with a lender that's saying that they don't charge for it. That's a trade secret. All lenders charge for a higher for the waiving of the escrows. It's just a matter of whether or not they're very transparent and tell you that they're just offsetting it by using what's called yield premium in the pricing, or if they charge you for it. We could definitely use a yield premium that's built into the pricing to offset that for you. You just have to let us know whether or not that truly is a course you want to take, and if I understand correctly, it is. So we'll just build that into our rates when we choose your locking. We'll just choose the waiving escrow option and take care of it for you. Okay, I hope to hear from you soon. Thanks, bye.